Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right. Really excited for the podcast today. I've got Andrew Horowitz. He's the president and founder of Horowitz & Company. They're a South Florida-based registered investment advisor with more than 3 decades of experience managing money for individuals and corporations. He brings a seasoned, disciplined approach to investment management. At Horowitz & Company, Andrew and his team has built custom disciplined portfolios tailored for each of their clients' risk tolerance, time horizon, and financial goals. What sets Andrew apart as a human being, as an investor, is his no-nonsense approach. He cuts through the noise and translates complex market concepts into clear, practical insights, which I really appreciate. And he's also the host of the Disciplined Investor podcast, so check that out. One of the longest-running independent investment podcasts. And he's also the author of The Disciplined Investor: Essential Strategies for Success and the Winning Investor. So his work, check him out. He's been all over the place. He's been on CNBC, Bloomberg, Wall Street Journal, Barron's, Reuters, New York Times, Fox News, NPR, you name it. So definitely a legend in the space. So Andrew, welcome to the show and thanks for your time.
Hey, thank you. Hey, appreciate you having me.
Yeah, absolutely. Well, why don't we start from the beginning? I know that you're in South Florida now. Tell me a little bit about your early, career. What you thought you would do in high school, what you kind of studied, and kind of how it led to investment management and kind of eventually building a platform in a community.
It's good. That's starting way back. I always had an interest in numbers. Mm-hmm. It was something that came easily to me. Math versus Spanish class, right? There was a definite distinction there from me of what I had capability of doing. Mm-hmm. Right? Spanish class, literally in 10th grade, I walked into the class. And I'm like, wait, they're talking in Spanish? I have no idea what's going on here, right? After 3 years of doing this. Sure. Whereas I walk into geometry, I'm like, well, that makes a lot of sense, right? I walked into statistics and I'm like, that I could do that. So that was kind of the basis of what I did there. I actually made an interesting turn. I actually decided to go to school and, well, that was college, of course. And then decided to leave early. I just was like, the whole thing wasn't working for me.
Sure.
Decided at that point to kind of look around what I want to do. Start out more in the financial services business. Back in those days, was only 2 different ways to do it. One was to be a stockbroker. One was to be an insurance guy.
Sure.
My dad was an insurance guy. He says, why don't you do that? And I said, Dad, that seems really boring. And, but I started out, right? I started out and got my, cut my teeth on that whole side of the business. And eventually moved down to South Florida from New York, actually. And I moved very quickly because I had this idea that if I really worked hard in New York and had those roots and was stuck, I couldn't do what I thought was great because everybody said when they retired, they're moving to Florida. I said, well, What am I waiting for? So I went down to Florida and it was much different Fort Lauderdale back then in 1987 than it is today. But I came down here literally with $5,000 in my pocket and an idea and a dream, right? That I would build this financial empire of some sort. That was the dream. It was an interesting process because when I came down here and I started working in the financial services industry, I very quickly started on the road to my CFP designation and got clients very quickly down here because I worked hard. And eventually met some really good people in the space and some of the people that were really breaking some unbelievable ground back in the day. And that piqued my interest in really going a lot further. And I studied every single thing that I could, anybody that was in the area of modern portfolio theory, the Markowitz gang and Brinson, Biebauer, and Hood, and look at William Sharp. I had the unique ability for whatever reason, or the unique experience to have opportunities to meet with a lot of these people back in the day and to have dinners with them. It was kind of I was young. I was just moving and grooving and doing my thing, and I was arguing with Biebauer one time about his when we look at downside variance versus standard deviation. And I was having these arguments about why are we doing this and this number should be here and that. And this from a little pisher back then, right? But I was loving it and wrote a lot of papers a lot of internal stuff that the small firm that we were at the time,
Mhm.
and just started expanding. So that's kind of, I'll stop there for a minute. I don't know if you want to, but basically that was the genesis of where we are today. The
Sure.
growth of the models, the business process, how we develop portfolios, and kind of course, throughout that time, had to grow, change, and emerge into different areas.
Sure. We've had, couple large RIAs on our podcast. And, one thing that I've seen that's interesting is kind of focusing on the white glove service and then kind of transitioning to kind of more of a standardized product. So we've seen some of these RIAs move to an endowment model. So what advice would you give to RIAs or just new investment managers kind of thinking through balancing, personalization versus standardization, especially when you're thinking about scaling?
So there's a couple of different parts of that. That's really interesting, because I think this all comes down to two things: what's good for you as the
Sure.
advisor, and what's good for the client. And I'm seriously about looking at this very, very seriously, because if you do something as an advisor that you're not comfortable with, I'm not talking about something that's illegal or it's a problem from a compliance standpoint. I'm not talking about that. I'm just saying it's not what you do.
Sure.
You're not going to be good at it. That may sound kind of logical, but at the same time, if you're working with clients that you don't really have a connection with and a desire to really service, and it becomes more just a process, I don't think that's a good idea.
One example is, providing OCI services, right? So OCIO services, some people really have that expertise and desire to kind of help people connect their accounts and really be kind of an outsourced CIO. And, that's really valuable for, some larger family offices, right? Because they may not want to, hire everybody in-house and do everything in-house. If they've got a partner that can kind of take a lot of that off their plate and kind of give them kind of a larger, high level view, like a pane of glass that kind of can help them understand all their holdings. It makes sense to just kind of outsource that versus bringing it in. But again, if that's a service that you're trying to offer and you hate doing that stuff, and you're not really the best person doing it, then maybe it's not worth kind of upselling that service, right? So,
right. If you hate, reconciling bank accounts and doing bill payments and things of that nature, and negotiating car leases, probably not going to be the best. If you want to be the guy that maybe is just crunching numbers and looking at models and developing that, then that's that other model, right? Which is the plug and play to a point. So, and there's the other thing of, client interaction too, right? So do you want to be meeting with them once a month, whether you're dealing with wealth management, that model, which is the idea of, you're going to be really, it doesn't have to be the CIO, the outsourced CIO model, but somewhere in between, right? Where you're the wealth manager, where you're dealing with somebody on a more regular basis. Maybe you're going to set up something like, month 1 through 3, we're going to deal with, redo and look at your investments again. Months 4 through 6, we're going to deal with insurance, and we're going to deal with risk management. And then we'll deal with your children and look at estate planning over that, and whatever that, if that's not something you want to do, even if there's a lot of money in it, and people, sometimes a lot of money clouds judgment, then you're not going to be good at it.
Yeah.
You have to find something that you enjoy. And there's so many different components of our business. And one that you mentioned from the top, I enjoy the educational, and also two ways, educating out and educating in. And how did I get that? How did I make sure that I was nurtured in my career to be a point that I could be effective, right? Well, I started doing these podcasts. I didn't know at the time that that's what was going to happen.
I'll tell you, the podcast is the best way to just digest expertise, in a compact way, right? So
I started doing these podcasts, and I've had, we're up to 980 podcasts, doing it since 2000. I think the first one I just looked the other day because I was curious about the anniversary that's coming up. It was 3/7/2007 was my first podcast. Podcast number 1 for the disciplined investor, before I knew even what a podcast really was. And I've had hundreds and hundreds of guests on, and made relationships with some names in the industry that are just, the names in the industry. I learn from them. So when I do probably exactly what you're doing, my friend, when I spend time, it's not like, okay, talk to the audience. I'm like, talk to me. I want to know. And then it's two people sitting on a bar stool, just kind of having a quick drink and a beer or whatever, and talking. And that then becomes this knowledge base that is essentially broadcast and absorbed by others. And if you do it in a way that is good for both sides, right? As I mentioned, in and out education. I'm always learning every single time I talk to somebody about what's going on, but that has given me the that kind of part of the process versus if I, for example, need to learn. We always need to learn, right? We need to keep up with everything. We need to keep up with what's going on in the markets, the trends in the business cycle, what's going on with the whole technology, all that. If I was somebody that was visual versus auditory, or I was literal, and I did something, in other words, if I had to read all this, I don't know if I could do it. If I had to absorb this all through reading, I don't know if I could do it. And this fit my particular personality and my educational style. So I guess the advice is, it may be a little bit cliche, but you got to do what you love.
I totally agree. I mean, if you enjoy what you're doing and you have a lot of fun and you're with good people, then it's you don't feel like you're working, right?
Right.
So
exactly.
Yeah.
What
are some of the biggest things that you've learned this year? With now the age of AI and automation's happening, what are some takeaways from maybe Q1 and Q2?
Well, there's a couple different sides of this. I think what I've learned over the last year plus Q1, Q2 is that the resilience of the investor during different times of market cycles is pretty amazing. Okay. You could have a situation where there's, for example, a war, a lack of oil, issues with regards to concern about geopolitics, inflationary measures, all this that you could have, and that may or may not trump the idea that companies are spending a lot of money and that's going into stocks. So, and into the valuations. I think the idea that we have a situation where AI, I'm kind of segueing here, AI is incredibly powerful. I've used this in my business, and we've slowly but surely adapted and adopted at the same time the idea of this whole AI thing and how to use it. And it's doing two things. One, in a weird way, it's making us smarter, right? Not from just saying, here's this stuff, give it back to us. I don't mean that. It's helping us ask a lot of questions that are proper in the form of what is now known as prompts, right? We prompt. So the question process and that's kind of making us a bit smarter on where to go, what to do, and how to do it. The other thing is it's saved an incredible amount of time, and it's providing us another very lowly paid employee. We're talking about, if your total outlay in an office is $200 a month for multiple seats on different platforms, that's kind of like, unless you have a big firm, but we're a small firm, but that's covered it all. And the ability to check things, just do rewrites, just like, I don't get this. Can you explain this to me for a second? I don't understand what's trying to be said here. Or, client comes at you and they're like, hey, what's this rule for my particular circumstance? And we're like, okay, we can go to the tax code and look this up. But first line, let's just go, hey, give me a little bit of understanding of what this is. And then we can go from there, right? It shortens the cycle by hours and hours and hours. Pretty amazing. So the AI thing is a pretty big thing. The other thing, if I may go a little bit further back, is we've been a very much integrated with technology, and the reason why we have a smaller firm with the size assets we have and how we could do with the amount of clients we have is because we have always been technology centric, right? Really heavy on technology. And what I have found is keeping that up is not always easy, but sometimes making a change. We made a change about 3 years ago that was painful. Our Salesforce change way back when was painful. And we customized a lot of things and did things, and we keep on doing that. But, then it's set for a while and it works really well. About 3 years ago, we made the change from Tamarack to Orion. which I'm sure you're familiar with.
Sure.
And that was painful for a lot of reasons. One was we had no idea why they were doing certain things, but we were committed to doing this because we knew it was smart to do. And we're glad we did, because it's really been, it has been business changing.
Sure.
This transition to cloud-based automated reconciliation process, where the manual entry is no longer there, the lack of potential mistakes, and the breadth of the actual offering that they have is pretty amazing, right? And the ability to really have a portal for clients and secure upload vaults for clients and performance data. It's more than we ever had before. It's amazing. Is it perfect? Absolutely not, right?
Sure.
It is not perfect. In fact, when we first started working with them, we know there was these huge firms with, multiple hundreds of billions of dollars that were on this platform. And we're like, excuse us, but this core element doesn't seem to work right. How is it that these big firms are using this? I don't understand.
Sure.
Like, well, let's take a look. And we probably had 5 core issues that we had them update and change from a core technology standpoint. Not like a glitch. I'm not talking about a glitch.
Yeah.
I'm not talking about a bug either. I'm talking about like non-functioning properly.
Sure.
Like some of the billing specs. I'm like, I don't know how anybody's using this, and they agreed with it. So I think the point I'll close with this is don't be scared to don't be scared to look to adopt and change along the way.
Yeah. And I think just for the audience, I think what you're referring to is just migrating from InvestNet Tamarack to Orion's advisor tech platform, right?
Mm-hmm.
And it looks like, most of the big areas for that movement is, obviously for clients, you have high net worth individuals, you have institutional clients, family offices, they're looking for data migration, trading and rebalancing, some type of integrations that they already have, maybe with their CRM, reporting, billing, training, all of that stuff. So it seems like a lot of that stuff kind of, just moving to a new stack could be a big change, but I'm assuming you want to crawl, walk, and run as you kind of think through that, right?
Well, it was crawl, walk, crawl, and then walk again for a while.
Yeah.
And then jog, by the way. And then
sure. Yeah, absolutely. Yeah. Do it slowly because you're dealing with client data. What are some of the biggest things that are top of mind for your clients that you've had to kind of obviously, evolve to support? And, because obviously some of these clients, they're in different stages, right? So walk me through, it doesn't have to be your specific clients, but with RIAs, there's, I have a friend who's an RIA that also has a fund-to-fund platform. And, a lot of his clients are like, exited entrepreneurs in Silicon Valley, right? And then a lot of the RIAs that I know in Florida, they're people that are thinking through decumulation, right? So how do you kind of think through what's your process to kind of, onboard a client and work with them and, really figure out what their goals are and come out with a solution that supports them specifically to make it more of a personalized white glove, experience? Yep.
So, I mean, like you said, there's different clients in different circumstances, different stages of their lives, different stages of their income earning capability. You have those people on the upslope, the downslope, right? Depending on where they want to be. You have some people that are simple, and some people that are very complex.
Sure.
Right. Sometimes the complexity is real and sometimes it isn't. I can tell you recently we had a client who was a high net worth, sold a practice, significant amount of funds came in, and he was with an advisor, and the complexity of what they had, I think it was for the sake of complexity and for the ability of the advisor to hold the client long term, because these were a lot of these were a lot of illiquid assets, a lot of private equity, and a lot of things that were very, very difficult to understand. And there was about 10 of those individual assets, plus in-house hedge funds, plus interval funds, plus other things in there. Everything was all about illiquidity. Now, I don't mean that in a bad way per se. There's nothing wrong with someone with high net worth having a long-term time horizon, and you don't need the liquidity, right? So you have that opportunity to stay in and not worry about it, right? But when I started the process, you have to ask a lot of questions. right?
Sure.
The simple stuff where somebody says, look, I have a $2 million portfolio. I really am out of touch with what my advisor's doing. I seem to like what you're doing. And that's really an easy process, right? You got to do a
Sure.
risk tolerance profile. You got to understand the time horizon, understand the family, what their income needs are, and all that. That is a relatively
Mhm.
easy process to onboard and to understand. You get into this other situation where you start asking questions about, okay, why do you have this XYZ private equity fund that really deals with last mile type of investing? Or why do you have this private credit that really focused on mezzanine? And it's a 3 to 6 month on the base, and this, fill in the blanks, right?
Yeah.
And you go through that, and every time you ask a question, they're like, I don't know.
Sure.
And now you're all of a sudden like, wait a minute, that's not great. I wouldn't even expect the super high net worth individuals, if I was to ask them the same questions, to really know those answers either,
Sure.
because I don't even know if the advisors that put them in those know those answers.
Yeah. And it sounds like some of these funds that you offer, the private equity strategies, are you using an SMA, using an institutional sleeve so that they can kind of invest through those accounts?
Yeah. So we really prefer not using the
Okay.
private equity. This was coming from another
Got it.
advisor that we adopted.
Sure.
Right. So we adopted these. My point was on the
Mhm.
onboarding where you asked me about, how
Mhm.
do you deal with understanding what's going on? We had to ask
Yeah.
a lot of questions here.
Sure.
And every time we asked a question on this one was, I don't know. The advisor
Mhm.
told me to do so.
Sure.
And we said, well, what we're going to do is we're going to figure out what all these things are, communicate that with you. You're part of the team in this
Yeah.
to a point that you can deal with it. Some people don't want to deal with it, but you need to be a part of a team. And the automation we have for capital calls, for example, this is a big
Mhm.
one. He was automating capital calls. The prior advisor was automating capital calls that were going to all the various private equity, private credit funds without the client's knowledge. Now,
Wow.
there was nothing wrong with that because the
Sure.
client agreed to that.
Yeah.
That was part of the agreement. They signed off
Mhm.
on the money links and all this stuff to go. And I said, you know what we're going to do? We're not doing that. Every single time, a little more work, but every single time in this particular circumstance, and any client of ours that has private equity capital calls, we mandate that they have to sign a brand new wire request every single time it happens.
Sure.
It's not that big of a deal to do that.
Yeah.
And therefore the client knows where the money's going in and out. Because capital, you got 50,000, 30,000, 75,000. They're just whacking out of the accounts.
Mhm.
And all of a sudden the client, starts to understand what's happening,
Sure.
why it's happening. And when there's an event, if that 4 to 7 year magical event time horizon for private
Mhm.
equity, we're going to have them involved in it
Sure.
and say, hey, this is what's going on. This is how are we going to redeploy this, et cetera. So the involvement of the client for those kinds of things versus, because he felt what we got from the first few meetings was that he felt out of it. He
Sure.
felt like all this money he made by selling his practice, and again, it was very substantial. And this particular circumstance, he felt very much like he built all this, and then all of a sudden, the money was taken away from him. He saw a number every once in a while. By the way, they were always late. You don't get
Sure.
valuations in for months on this stuff. That advisor, that stuff was late. Our
Mhm.
stuff to him now is daily updated. All those through Orion, we can track all this,
Sure.
all the valuations, even though we don't exactly know the valuation from time to time, right? The 6 months
Mhm.
late anyway, a lot of these.
Sure.
Point is, you gotta align with the client, what they need, what they want, even though sometimes they don't know.
Mhm.
And that's how you get through that process.
Sure. Well, that's really helpful. I also want to plug in your book here. Highly recommend this as a great resource. And we got about 2 minutes left. So what I'd like to do is maybe have you share one piece of advice. It could be obviously a topic from the book, or just a piece of advice from a mentor, or a family member, or someone that you've gotten some wisdom from, or it could just be something from your experience. Being in this space for a long time.
I think the best thing that I've ever learned was to stop trying to be right all the time. And once you get beyond that, your ideals in investing will change a bit. The idea that, I know that this stock is going down. Meanwhile, you're short it and you're off by 45%. Maybe you're not so right. Or that with clients, that clients have good ideas, right? There's sometimes clients come. I remember very distinctly myself, other advisors, client comes up with an idea. You're like, not really. Right. But that's okay. They have good ideas, and sometimes they can be involved. So stop trying to be right all the time. Try to be authentic, right? Try to be able to switch your mind, switch your ideas, switch your ideals with what's going on, depending on the time, and try to do the right thing rather than be right. That's the best thing I could tell you.
That was really helpful advice. I'm reading a book currently called Ego is Enemy. And it's, although it sounds pretty straightforward, there's a bunch of these case studies where, a lot of times your ego kind of clouds your judgment. And, a lot of times, there's points where you just really, to your point, trying to be right all the time, where you can just kind of set aside your ego and have an open mind. And that gives you a clear opportunity to kind of focus on your goals versus kind of the hubris and the thesis that you're always supposed to be right or prove yourself. So, totally agree with that. And Andrew, really enjoyed having you as a guest on the podcast and sharing all your wisdom. I'm very confident that a lot of my audience is going to get a lot of value, and excited to check out the book as well.
I appreciate it. And The Disciplined Investor, by the way, you can grab it on YouTube or Amazon Music, wherever you find it. But great platform you have here. I really appreciate you having me on.
Thank you so much. Appreciate it. Everybody else have a great day. And how global markets are driving capital allocation. So join us on this journey as we explore these insights.